Okay. Please, boys, Alessandro.
Thanks,
the floor is yours.
Hello, everyone. Thanks for having us here. It's a pleasure to present to people who are passionate about artificial intelligence. We are equally passionate at InvestCloud. We have a team of data scientists and AI experts that work on interesting themes. But obviously, we are almost even more passionate strategically about wealth management. We are a vendor that develops solutions that help the front office and the middle office of private banks to better manage their client, to be faster in serving them, to better personalize what can be presented, suggested, offered to their client audience. So in a way, we see artificial intelligence as a mean to an end to provide better client service and more effectiveness for the relationship manager. So in the last few years, as we've been deploying our front office solution on many private banks and wealth managers, we started analyzing which issues come up more often, where there's more frustration, where there's more point of friction in the daily life of a relationship manager. And we identified quite a few, and we've been tackling them with different approaches within artificial intelligence, machine learning, a rule-based or reasoning approach, with natural language processing. Maybe we will not go into detail in all of those topics. For today, we'll focus on one specific angle of that, which is providing recommendation on what is the best next action, what element, what proposal, what investment should be the most interesting for a client, given their history and their circumstances. That's a hot topic in the industries because of some of the reasons that you see now. There is an appetite to make the relationship manager both more effective at selling, more productive in doing their daily job, but also more compliant and make sure that they don't recommend products that are unsuitable or bad or not in the best interest of their clients. So there's definitely a huge demand. A lot of the experiences we'll share today have already been implemented at multiple banks. So we already have a bit of an observation point about the productivity impact and about what works and what doesn't work. I think at the end of the presentation of Boris, we'd love your feedback. Feel free to ask questions even during the presentation. But I think some of the topic I'll leave you with is that our experience so far gave us the sense that only if you focus on a vertical domain, only if you really understand what works out there in the world before you deploy artificial intelligence, you can really make good progress using AI. So understand the domain and make sure that you choose the AI techniques which are more suitable to solve the problems that you're trying to solve. So basically, start from the business and pick the right AI approach. And then one topic that I'm sure most of you are aware, that obviously data is key. The more meaningful data you have to leverage, the better things will work. So making sure that you can derive good data, clean data, meaningful data from your operational system and making available to the different analytical tools, the more successful you will be in your AI endeavors. So that's a bit the wisdom was distilled, but I'm sure both the devil and the interesting stories in the detail. So I would ask my colleague Boris to give you a better sense for the problem we're trying to solve and which is the approach we took in tackling that problem.
Thank you, Alessandro. So let's start with a motivating example. We often hear like, how can you apply in order to propose this, to users of Netflix, then the system is basically clustering the series in the movies, for example, into two different topics: movies that are maybe more interesting for female users, and series that are more interesting for male users. So this is one example of how the clustering can be done. Of course, this is only illustrative. Then you can add a further dimension. Some series or movies are more interesting for people that like realistic stories, and some movies are more like science fiction, or don't really match real life, right? But there are people with preferences to watch stories which are not so much related to real life, and they maybe can project themselves into the different let's say characters in these movies. When we add a third dimension, drama and comedy, you see slowly how such algorithms can cluster series and movies into different topic areas. And based on your preferences, based on what you have watched in the past, maybe you started but you did not end a series or a movie, the system can find out in which areas are you interested, and then make proposals to you what to watch next. The question is now, can we also apply these kind of techniques, which are also used, for example, at Amazon for products, or at Spotify to make recommendations for music, to create personalized playlist compilations? Can we apply this also to the financial domain, where we have thousands of financial products that people can invest in, and we have people that have different financial needs, different investment objectives, and also different preferences how to invest capital, depending on investment style, different regions, sustainability preferences. So can we also apply these techniques to financial products? And when we continue this, let's say, illustrative example, let's say we have a couple of stocks, you could potentially cluster them into active and passive investments. You can then further cluster them into value investments and growth investments, reflecting a specific investment style. We can further cluster them into small cap, large cap. So also here, financial products, they share some properties, and you can, cluster them into different, differentiate them into different clusters, and then try to profile users and clients and investors to see what are their preferences, their implicit preferences. Of course, in reality, you have much more dimensions, you have much more features that you have to consider, like direct investments versus collective investments. You have different sectors, regions, industries, countries that you can consider. You have different investment themes like self-driving cars, robotics, so thematic investing. You have different ESG preferences. So ESG is a very broad concept, but when you look at the data that ESG providers can provide, so looking at Morningstar or Sustainalytics, Refinitiv, they provide 450 to 400, different ESG data points to the security master. So lots of additional data where you can, work on in order to find the preferences. So that was our intentional idea, to look at the other industries, how they apply recommender technology, and to transfer this knowledge into the financial domain. So, when we look now into, how banks operate, you have in most banks, you have research departments, you have a chief investment office, and, they do all the research on the markets. They scan the huge set that is available on investment opportunities, and, they make recommendations, what to do next, what they would recommend to investors. And when you look at a specific example here from UBS, you can subscribe to this CIO letter where you get investment ideas from UBS. And this is like a letter with lots of recommendations. I just copy pasted here on extract. So the CIO is recommending US high yield credit, is recommending to invest in emerging market US dollar denominated sovereign bonds, Asian high yield credit, green bonds, US investment grade, Asian investment grade credit, etc., etc. So behind these ideas, you have hundreds of securities. And question is now, how can you, this is like, how can you funnel this down to the specific investor and propose the right idea to the right investor? Because not everyone is interested in this broad set of recommendations, or does not even equally apply. When we look at, the situation of a financial advisor within a bank, typically a financial advisor or relationship manager has maybe 50 to 300 clients he's taking care of, depending on the institution. And the financial advisor has to deal with lots of information. So as said, like, from the research and CIO department, you get all this content. So you get all the high conviction ideas, you get the recommendation lists, the preferred asset lists on the different asset classes like equity, fixed income, mutual funds, alternatives, with hundreds of securities, typically stored somewhere in the intranet. And the financial advisors, they can then go there and screen for securities. Orders, and you are not allowed to do that in all circumstances or for all products or for all services. There might be a negative tax impact on a client if you propose a specific fund, or it might be that you are not allowed to show this fund to the client because of distribution rules in that country. It has to be a professional client and not a retail client. So lots of information, lots of regulations at the point of sale that makes for the advisor, the life very hard to manage 300 clients and to provide to all of them personalized financial advice. So what is the outcome of this is that advisors typically focus on a very small number of clients, their wealthiest, their largest clients, where they actively, proactively approach them. And for the rest of the clients, they act more on an ad hoc basis or passive basis. When clients are calling, they provide financial advice to them. So the idea is really to look at these other industries, how they apply recommender technology, and to transfer that into the financial domain. And one big challenge here is, of course, how can you combine recommender technology, with this complex environment within banking in terms of it has to fit into the portfolio. You have to fulfill all compliance and regulatory rules, whatever you propose to a client. So it's when you propose, let's say in Netflix, some movie to a user and the user doesn't like it, it has less impact on the user's life than if you propose a financial investment to a client. It might have quite some negative impact on his financial well-being. So when you look at how Wikipedia classifies or explains recommender systems that are used by many companies, let's say the short definition is you try to predict the preference of a user for a specific item. And user can be different things, can be a client, but can also be an internal, let's say, bank employee. And item can be also different things like tradable products, investment ideas, but can also be publications, content, which you would like to show to the client. And broadly speaking, there are like different recommendation technologies you can apply. So the easiest one is knowledge-based. So this is what banks already do today. So they, during the risk, let's say, profiling process, they ask their clients Do you have some specific preferences, restrictions? You know, a client might say, I don't want to invest, you know, in US stocks for some reason, or I don't want to invest any, you know, anything in real estate because I already own a house and I don't want to invest in some real estate fund, or I'm not interested in hedge funds because they are so expensive. So they make explicit preferences and references, and of course you can use this then you know, to provide recommendations as well. So they might say, you know, they are interested in investments in high yield emerging market in Asia. Then of course, whenever there is some content or some investment idea or some new product, you can then push it to the client. The same on the content. So for example, when you have client portals where client can subscribe to content based on they like some content from a specific research analyst or from a specific author, or when the CIO is publishing the monthly market outlook, they can subscribe and they get this content, you know, pushed to their mobile app or to the client portal. So this is knowledge-based, explicit preferences. And then data-based is collaborative filtering and content-based. Content-based is basically, you know, we analyze the, you know, the activity of the client. So what is the client, you know, trading? What has the client traded in the past? What is the client, you know, watching, or which documents is the client opening in a mobile app or a portal? And then by clustering the different products, we can then, you know, propose, you know, similar products to the client that he already was interested in the past. But it's considering only his own history. And collaborative filtering is really doing this like across the whole client base. So we are also looking at correlations, not only between products, but also on correlations between different clients, you know, so where then clients who are similar to you are looking at something or investing in something, and they have a similar, let's say, pattern like you can cross-sell this product also to the other client. In terms of data that we typically work with, so there is lots of data within a bank on products and also clients that you can use. You know, you have like data during the KYC process when you onboard new clients, where you ask lots of questions and also document this about source of wealth, you know, income, family situation. You and, you know, are doing risk profiling and investment objectives, where you also collect lots of data about the client. Then you have like the client, you know, being in the different digital channels like e-banking, mobile app, in client portal, where you can, you know, record the user activity and see what the client is doing. You can look at the client's current portfolio. You can look at how client has invested in the past. So all of this gives you like lots of data which you can use to, you know, learn the preferences, the implicit preferences of the client. At the end, of course, what is important is that it's not only about, you know, looking at the client's affinity to specific products based on his own history or based on his similarity to other clients. At the end, it always has also to fit into the client's portfolio, what you propose. So, you know, it has to, there is like a regulatory and compliance dimension. So you have to make sure that when you propose an idea to a client to invest, for example, in this fund, you know, the client has knowledge and experience in that product class. The product is suitable for the client's portfolio. So it does not, you know, increase the risk in the portfolio, which is leading them to a risk which is above the client's risk profile and agreed risk budget. The portfolio you should not encourage the client to build up concentration risk or sector risk by, you know, proposing every month the same ideas from the same sector. You should always try to, you know, convince the client to build diversified portfolios. You also have to consider what's the current positioning of the bank, what's the house view of the bank. So if a bank, for example, is negative on a specific bond sector, you don't want possibly to propose ideas from this bond sector to the client because that would be in contradiction to the house view of the bank. You also have to look at, you know, what is the current client portfolio. If the client, for example, already has lots of exposure in a specific sector, you also don't want to propose ideas for this sector. So you really have to make sure that you fulfill all the compliance rules and regulatory requirements, and that you also provide ideas where it fits into the client's portfolio in terms of investment objectives, so in terms of risk and return. But at the same time, we try to filter for the products that the client also has a higher affinity to, because this at the end drives higher conversion. So whatever you show to the client, there is a bigger chance that the client will like it, will look at it, will maybe have a discussion with the relationship manager, and finally invest into this product. So, and driving through this then higher conversion rates. That's the ultimate goal. And of course, also by providing personalized ideas in terms of products, but also in terms of content, clients are motivated to log in more often into the client portal, looking what's new. It's not a static page, but there's always new content which is shown to you. You have like higher client engagement, which also increases then the stickiness of your clients. So how all of this resulted in a product which we developed over the years with different banks, and here you see like how it is composed of. So basically we have like a machine learning layer which has currently more than 20 models. So classical machine learning models from the recommendation technology space, like collaborative filtering, etc. We have also separate models to create explanations in the feature space. So this is like also like a trend in AI called explainable AI, that you don't want just black box behavior, but you also want to understand, why do I get this output based, for this specific client. This is also very important for relationship managers when you distribute these ideas to relationship managers, and they have then to decide, which ideas to take and to discuss with their clients, that they also get this explanation and understand, yes, that really makes sense that this has been proposed for this client. Because at the end,
there was just a question. So basically, since this needs to be explainable, it almost excludes the use of a neural network, right?
Yeah, actually we are not using neural networks.
Yeah. You need, yeah, the best algorithms are sometimes the simplest one, right? I mean, I'm not saying it's simple, but in terms of architecture.
So we strictly follow Occam's razor. Yes, we don't use like the most complex deep learning or reinforcement learning techniques to solve this problem. In terms of machine learning models that we use, I would say this is classical machine learning. So most of the data that we use for the recommendations on investment products is available as structured data. So this first thing, and then we use like really classical machine learning models like collaborative filtering, model-based classifiers, clustering techniques. We use models for feature selection. We have different models to model the implicit rating, because when you look at, for example, Amazon, you can look how people rate products. They give reviews. They give written reviews, so they give 1 to 5 stars, and this is typically something you don't have available at banks, right? So you can look at the past transactions they have done, probably what they opened, which documents they opened, etc. And then you have to infer whether would the client, let's say the client has invested in Tesla 2 years ago for a period of 18 months. You have now to judge whether was the client happy? Would he give 1, 2, 3, 4, or 5 stars for this investment, right? And so we have different models how we derive these implicit ratings. Was the client happy with that transaction or not? But this is more or less, let's say, classical machine learning models. So we don't use deep learning in that context. What we use is NLP for publications. So, for example, one area where we are active is, to do auto classification of documents using like topic modeling techniques from NLP, so that we, can construct metadata on the documents, and then we can also use, we can personalize. When you have assets, you have your, let's say, asset taxonomy, how you categorize a specific stock or a specific bond or a specific mutual fund, and we use the same taxonomy also for documents. but often you don't have this taxonomy available for documents. So we apply NLP topic modeling techniques to categorize these documents, and then we can use the same techniques basically to distribute publications personalized through client channels, and use basically like the same set of techniques as we use for investment products.
Yeah, thanks. There was a question from Edward, but he was trying to say, do you see the question?
No, I don't see the question.
In the chat, how is the
Maybe
change?
I can pick it up, Patrick.
Okay.
The question was about almost the distribution of those ideas, of those recommendations, and how they might change, depending on the segment of the client. And here, obviously, in a way, the AI exercise is really to come up with that recommendation. Then the decision on how to distribute, we do support it technologically, but it's also part of how each bank goes to market. But as Edward was suggesting, obviously, if you're doing height and worth, the higher the chances the bank will say, we want the engine to deliver an idea, and then maybe that idea will be delivered verbally in a meeting, in a Zoom call between the relationship manager and the client, just to, because it's worth investing in the relationship, not only in pushing the idea. Whereas maybe as you go more into the mass affluent space, it's more likely that that idea can be published directly to the website of the bank or the portal of the client, so that there's almost no effort, from a human point of view. Again, that's really a matter of communication style than necessarily part of the AI recommendation. But yes, technically, we do put a lot of attention on those different distribution geometries. Sometimes we allow to publish it to the client directly, but we want to notify the banker, because otherwise he will be off sync. He won't be able to defend that discussion next time the client and the banker meet. So yeah, that's definitely very important. That's how you really monetize or make the value happen between bank and client. But it's more of a business decision than an algorithmic determination from the system.
Great, Alexander. I think you answered the question quite extensively. Thank you very much. Yeah, Boris, back to you. Sorry.
So I'm actually on the last slide. Maybe what's important to say here is you see, like, you have this pure data-driven part, which is in a machine learning layer, where you do the predictions. And I mean, what you get as output here basically is a kind of propensity matrix that you, for every client that you have, in your book of business, and for every product that you want, to apply this. So being it an investment product or being it a publication, you get some sort of rating. Let's say between 1 and 5. 5 being potentially the likeliness that the client is interested in this, product is high, and 1 meaning we think the client is less interested. This is a pure data-driven approach. But we have then on top this investment layer. And this investment layer is classical software engineering. It's different rules that you program on top of this data-driven layer. Because what you need in the banking context is, when we talk about, let's say, machine learning KPIs, like for example accuracy, when you do image detection, nowadays I don't know exactly what's like benchmark, but you are maybe at 98 or 99% accuracy. So if you are showing like 1,000, let's say 100 pictures and the algorithm has to detect whether on this picture is a cat, for the 100 pictures, the algorithm is designing correctly in 98 cases, but in 2 cases, for 2 pictures, it's deciding wrongly. And in the banking context, you have to have 100% accuracy. So you have to be sure whatever is proposed to a client, 100% sure it fulfills all the regulatory and compliance rules that you have within the bank. So the investment layer makes sure that this happens. So even if, let's say, a product is ranked highly, in terms of client might be interested, but it does not pass all the investment layer filter and rules, it will be dropped from this list. And we take the next, and we drop all the products, or let's say topics which do not pass the investment layer. we drop them and we take the first one which passes this layer. And then you have like, you are sure that, you know, what you propose to a client is in line with the house view of the bank. It comes from the bank's recommendation lists. It does not increase concentration risk for the client. All of these things. And then you propose the product together with some, you know, investment narrative. You show like why the bank thinks that this is a good investment specifically for the client. You attach some documentation, you show some performance, past performance, you know, the impact on the client's portfolio if he would invest in that. And the investment layer is therefore a very important part in that whole next best action system. And of course, this is then also from every bank to bank a bit different. You can configure that, you know, have different inputs. But important thing is the machine learning layer is really data driven, and you know, we run the same procedures almost for every bank. Of course, every bank has a bit different data they can make available to us, but this is more or less purely data driven.
I think
Boris, I have a question for you. Just to take back one step. So the bank start with the universe of instruments that they consider in only the most simple selection criteria to say, okay, these are the ones that we consider they are going to be in the green area. They're going to be positive in the next 6 months or 9 months. This is the first universe. So they are not going to start recommendation with what they consider it is not good. But they take a very objective look into the instruments, and out of that, they started the selection process. Now, my question to you is, do they have this a triage or an ordering in the way they are going to apply the selection? Are they starting with restrictions and with constraints, and then after with geographical constraints, or because not all the selections have the same weight? So how do you during the process, how do you weight the algorithms, and which algorithm has more weight into the other, and so on? Because I think this is where the value of the system has that you bring, you know, because after that they can say, okay, the restrictions for my client are a bit different, but you know that the restrictions kick in after in the number 2 or the number 3. How does it work, this?
Yeah, it's a good example, because we actually had exactly this example with a bank. You know, typically you don't have just, let's say, one universe, which is your recommendation list. Let's say you have you know, a hierarchy of, let's say, universes. So, for example, with one bank, this hierarchy, or let's say this preference, as you described, was we first look at, you know, the preferred asset list for discretionary mandates, which they have in model portfolios. This is typically much a smaller universe. Then they extended this in a second step to focus lists, you know, where they have like high conviction ideas for different asset classes. And then there was like an advisory universe, you know, approved instruments for advisory clients. And of course, there is then even a bigger universe also for the execution only clients, but we did not extend to the execution only universe. So we had like these preferred assets for discretionary mandates, then we have the focus lists with high conviction ideas, and then we have the advisory universe. And the system starts from the top. If it doesn't find the product which it can take from there, then it goes down until the third list. And you know, the thing is, what we have seen in the use cases with our clients is we had some clients where the ideas go straight through to you know, the client channel, and the advisor is receiving the same idea, so is always informed about what clients receive. But most use cases, most of our clients have worked with us in a way that the ideas are shipped to the relationship manager into his CRM or RM desktop, and we provide to the relationship manager or the investment advisor several ideas. So I can give you an example. The system, for example, scans for client portfolios with a high cash position, you know, where the cash position is 40%, but based on the risk profile and investment objectives, it should be around 10% or 5%. So we scan for these client portfolios, and then we make buy ideas against this cash. And we provide to the RM not just one idea, but 3 or 5 ideas, you know. And the RM can then go into this and, you know, evaluate, look at the ideas, can click into it, is getting some additional information, explanation why this would fit into the client's portfolio. And then he can select, for example, 1, 2, or 3 ideas, and can also select like how much he would recommend the client to invest in. And then he can create a proposal, investment proposal. So the idea is really to provide the advisors, you know, give them a decision support, because they have 300 clients. Let's say they have 250, and they meet every client once in a year. So they would have every day 1 meeting, let's say. And you give them all the materials that they can prepare this meeting in advance very efficiently. But, you know, we don't want to provide to them a black box they can't influence. So you know, you can imagine that the change process would be quite difficult, because you would kind of take the RM out of the equation. And that's a dangerous thing to do.
And how do you manage to associate the narrative justification for the ideas? It is something that you are also handling with the NLP, also that you have associated for the given instrument, the narrative, and that with via, I don't know, a transformative algorithm, it is going there and pitching the pieces of the text and bringing these keywords into the narrative to the relationship manager, or it is something that is somebody doing by hand?
No, so we have basically two dimensions of narratives. One is to provide to the RM the explanation in the feature space, you know, why this client is interested in. So one explanation could be like, this client in the past invested, there is a pattern that this client likes, you know, value stocks, you know, with specific, let's say, sustainability criteria, and maybe with a specific, you know, taste for specific regions. So we provide the RM an explanation in the feature space, so that he knows, like, you know, why this product has been selected. Then there is an investment narrative as well. Why should, you know, which you should provide to the client. And here, for example, what we have done also is that, you know, these investment narratives are often delivered to RMs in PDF format. So you get like a CIO market outlook, where, you know, you see like the bank is currently now positive on, you know, US stocks, US tech stocks, and there is a change compared to the previous months. And then there is, in the PDF, you have like the narrative, the explanation, and so we extract these text snippets out of the PDF, and you know, automatically provide these when we have a client who has, like, let's say, a low exposure in this sector, and the bank is positive on this sector, and at the same time the client has a high cash position. We make ideas for this sector which are in line with the house view, and provide the narrative out of this PDF document, you know, where the bank explains, you know, the reasons why you should invest now in this sector. But
this process is automatized.
It's automated, yes.
Yeah, it's automated. Okay. And the other aspect which is very interesting is in the way you construct this. So the construction of the portfolio recommendation or the rebalancing proposal, this is going to be done by the relationship manager. So it's not going to be as a rebalancing proposition for the client, or you are not yet there.
Yeah. So how we tackle this currently is, you know, we have like, you know, let's say you have a dashboard where the RM logs in, and he's seeing, like, you know, alerts from the portfolio monitoring, and he's seeing, like, you know, actions generated, how you could remediate these alerts. And these alerts are not only, or notifications are not only regulatory alerts that you have a suitability breach. It's also like there are clients with high cash positions, you know, or there is like client which is invested in securities which are not anymore on a bank's recommendation list, or there are product expirations. So creating really buy and switch proposals. And then we present a number of ideas, alternatives to the RM. He can then select, and then he can select the ideas he would like to create the proposal. And then he selects these ideas, he can evaluate them, look at the materials, and then he can start the investment proposal process, which is also based on predefined templates with, you know, all the data already in it. and then he can adjust how much he wants to invest. Let's say client has, I don't know, $200,000 in cash, and ideally, based on his investment objectives and the profile, he should maybe be like at $50,000. So he can now adjust how much of the $150,000 he wants to spread across 3 ideas, for example, and then he includes that in the investment proposal. He can also add manually comments. So the narratives, they are automatically pre-populated. They are coming through the system, but he can also remove them, or he can add additional explanations. You have to give the RM this flexibility that he can, override the system. He can add additional text, and then he can share this with his client.
Okay.
There's a question coming from Guy, I think, right? So go ahead.
The question was, does the machine learning learn from those recommendations that the client advisor is making, and does it also learn from the decisions that are then made? So the advisor could propose something and the client could go, love that, or the client could go, no. And does that then get fed back into the machine learning layer to make better proposals for that specific client based on their sort of behaviors?
Yes, absolutely. So, when in the beginning, when you start such a system, you have different, let's say, offline KPIs that you evaluate when you design the system. You have your training data, and you then, you have to do like, if you're familiar with machine learning, let's say cycle, you have different parameters, hyperparameters. You have to do a search across these hyperparameters, and then you train, and then you test your KPIs on the validation data set. Once you are happy, you kind of say, okay, I'm happy now with my results. You do the final test on the test data, which the model has not seen yet. But it's everything offline testing, right? Then you put the system live, and then you have like you can measure the system in the online world, right? So that means you can look at conversion rates, and you can measure how the system works. And when the system is put online, you get this feedback, from the users. So in Amazon you have the 5 stars. With investment ideas, what we look at is when we present the idea to the client or to the RM, depending on which channel you use. Let's say we look at the client, we look whether the client is ignoring the idea. So this is one sort of feedback. If the client is clicking on the idea and browsing it, this is already a stronger, more positive feedback than ignoring. Then you have in the user interface that we develop with our clients. Client can browse it, can save it for later. So maybe he likes the idea, but he doesn't want to invest right now. He has to think about it and maybe for later. And this is again a stronger feedback. And then you measure the client has traded. So that's the strongest feedback. And you can also measure whether the client dismisses the idea. And this feedback, this is called explicit rating. This goes back into the system. And this is where we get this explicit feedback when we have the system live. We don't have this, we don't have this feedback when we train the system in the beginning. With exception, if a bank has the history of, which proposals they made to their clients and which proposals have been accepted and which not. Then you could use that, but this is normally not available.
And I think you rightly inferred, this is even more critical in an investment scenario than on Netflix, because your preferences might change very abruptly. Yes, you were a true believer in biotechnology 2 years ago, but you recently lost a lot of money, or maybe your cousin lost a lot of money, so you got burned. So if you miss those signals that you reject the proposal and you keep operating based on the old model, no, that would be out of date and maybe even counterproductively geared on the client history very, very soon. So it's crucial that you keep it as up to date as possible, and you know how to weight the fact that a recent decision counts much more than an older decision.
I have a quick,
Alessandro, go ahead.
I have a few questions that are a bit technical, Boris. Just to go back a little bit to machine learning, because you don't need to tell me your secrets, by the way, but um, the system needs a certain amount of data, right? Obviously, right? And I guess you cannot do transfer learning from one bank to the next, right? I'm sure the banks wouldn't like that you use a pre-trained model from with another bank, I guess, right? So how large should be the client base to have a kind of a good, distribution, data distribution?
Yeah, maybe you touched an interesting point, transfer learning. So basically what we don't need is, when you look at image recognition, for example, image detection, the best algorithms are where you use pre-trained models, and then you apply these pre-trained models to your new data sets, and you can be much faster in training your updated models. With recommender systems and the kind of data we work with, this is not really needed. Of course, if we would have much more clients that we could then model also from other banks, but this is not really needed. What we need, or let's say have applied, is when you do this hyperparameter search of the parameters, because you have also hyperparameters in this system, and you have to search for them, and this is time consuming. And working with different banks, we already know where the regions are where you have basically to restrict your search so that you can train your models faster. Then in terms of let's say the smallest data sample that we had was about 2,500 clients, and typically you should have like one client in his history invested in more than like 10 15 investment products. If this is below, you can't really infer something. But 1,500 clients is kind of
enough. Yeah.
Enough, yeah. What we have seen, for example, we have done some projects, also pilot projects or POC projects with cantonal banks in Switzerland, which, let's say, are not typically very, the main business is not private banking, and there, like most of the clients have, had very similar portfolios. They follow like the model portfolio approach of the relationship managers. So there was not a big, dispersion in different products. And there, like the recommendations, they were not able to really beat the benchmark model, which was like just propose the most popular products which have been traded. So there needs to be some, dispersion in the different client portfolios. And that is what you typically see with private banks in the advisory context. They have very diverse portfolios, and this is something which facilitates the use of recommender systems.
Okay. Is that your last slide, or you need to?
No, it's the last slide.
Okay, then Miguel, you can, because we have 7 minutes left over, more or less. So Miguel, go ahead.
Yeah, thank you, Patrick, thank you, Boris. Yeah, I have a couple of questions. You mentioned in the machine learning layer that you actually right now you're using kind of like a traditional machine learning techniques or models, and my question is that because the model accuracy that you see is better, or is because the explainability itself of the model is complex, and then it requires it's not possible because of that complexity of the model, and then you have to explain that and all of that, or is because another reason?
You think why we are not using like
another techniques, like for example deep learning or neural networks?
Yeah, I mean, I think we looked, of course, when you look at next best action, the biggest challenge, I would say, is to integrate everything into this financial context where it has to fit the client's portfolio, it has to be compliant with all rules.
Right.
And of course, for the data part, you can try different models, but also for there, when you look at deep learning is very good if you try to find some geometrical structures in your data, right? So it's very good for image detection. I think it's very good also like in doing language recognition, but already maybe less than for image detection. So what really works very well in recommendations is collaborative filtering, model-based, and this was like sufficient for our needs, right? So what we spent more work on is creating good explanations so that we don't have this black box behavior of the models, that we can also analyze how do we find out whether clients were happy with a specific investment, defining, like, let's say you say if a client invested in Tesla 2 years ago, he was happy with that product, but you could look at how long was his holding period. The longer the holding period, maybe he was more happy with the product. Or if there was a high trading activity, the client decreased, increased, decreased, so he followed this company maybe very actively, and that gives you different type of signals that you can use then in your learning procedure. And model-based collaborative filtering is very well suited for this kind of signals to work with. And
understand. Okay.
That was like the main reason that we did not spend. We didn't want to over-engineer that, because at the end it's just one piece in the overall system that contributes to its value.
So related to this question, then, the AI technology is evolving very fast. So how do you see that evolution impacting the wealth management industry? Or, because what you are saying mainly is that, well, traditional machine learning is kind of working quite well, and maybe those kind of new technologies, new recent research is not at this point yet. So how do you see the evolution of that?
Yeah, I see like that the evolution is, banks have, or wealth management firms have different challenges. I think it's not, the challenge is not to apply the latest AI techniques, because, if you look at the Python ecosystem, all the frameworks, TensorFlow, Keras, etc. I mean, you can set up easily deep learning models, which a lot of work is done in the background. You just have to parameterize and define your layers, etc. So you find lots of data scientists who can do that and apply all the models. One of the bigger challenges is how do you set up an operating model within a bank, where you can prototype models, you can put it into production, you can maybe do A/B testing, you manage model life cycle, you have, you manage data quality. All of this is a bigger challenge in banks, I think, into production. And then in terms of technology, AI, I think, I don't see so much use of deep learning in banks. Maybe on the investment side with, let's say, hedge funds or asset managers, try to analyze satellite data or alternative data sets to get an edge and create alpha. But let's say in the wealth management space, where we advise clients and we are more on the distribution part, I really see the classical machine learning technique for recommendations like we do, fraud detection. Then I see lots of NLP techniques be applied to handle unstructured data, to automate processes where lots of PDF documents or free text. In many applications, you still have lots of free text fields where you add CRM notes, you add complaints in free text. So getting sentiment out of it, getting information out of NLP or free text. This is I would say the main techniques that we see that banks and wealth management firms apply.
Okay. Thank you.
Do you have another question, Miguel?
You
have lots of questions. I have lots of questions.
One more is related to the just a curiosity.
We have to organize a second meeting because I have also a few questions still, but we have one more minute only.
Miguel, go ahead.
No, it's just out of curiosity. So, for example, I guess that the models, you will have to retrain them, right? So, because eventually they will degrade, I guess. So how is the frequency or how that you retrain you maintain your models?
That depends a lot on how dynamic is the data. So, for example, for these investment recommenders, we typically have a monthly retraining of the models.
Okay.
And then, every 6 months, we do a new new hyperparameter search.
Oh, okay.
Cross validation. that you don't do this every month. So, but if you for example are using I don't know, streaming data, high frequency data, then of course the picture is different.
So maybe the future is then online training.
Yeah, absolutely, yeah.
Maybe, but okay, that's a different topic. But frankly, it was great presentation, very interesting, at least for me or for us. And
Really
we
nice.
could we could continue like that for hours, most probably, right? Because Miguel has more questions, I have more questions, Jorge has more questions, the audience maybe has more questions as well. But frankly, that was really, really great, Boris and Alessandro. That was very insightful. Thank you so much for taking the time with us. And yeah, and I'll put the recording of the video on our event page, right? And then I'm sure quite a number of people will look at the recording later on. Thanks so much. Have a nice evening. Thanks.
Great. Thanks for having us.
Thank you very much.
Boris.
Thank you very much,
Thanks,
Boris, Alessandro. Bye bye, guys, everybody.
Bye bye.
Thanks a lot.
Thank you.